And hello, everyone. John Hutchinson with Traders Reserve's Millionaire Blueprint. It is 8 o'clock Eastern Time on, I think it's Tuesday. I've been doing so many of these over the last few days, I can't keep my days straight. We're going to get started here in about 2 minutes or less. As the sticky notice in the chat box as it sort of explains, please be patient. There is about a 60-second audio delay before my voice actually reaches you. But once I get going with the presentation, don't worry, that delay should not have a big impact. You should be able to keep up just fine. But once we get rolling. We are recording today's session. We've also recorded previous session, so I'll give you access to that recording and let you know how to get access to this recording once we reach the end of tonight's webinar. Running time should be about 45 minutes. Stick around and do as much Q&A as you folks need at the end. So feel free to load up questions in the question and chat box as we get underway. But real quickly, just want to do a brief audio check. So I know it probably took a few seconds for the audio to start reaching you, but if you could, please just type a yes or a Y in the chat box and let me know that you can hear the audio okay. If for any reason you do have a problem, this is a new technology that we're still learning, if you will. So if you do have a problem, the simplest things that we've found are to log out, log right back in through the email link or the web page link that you had as a registration. After you registered, excuse me. So you can do either of those, or you can also use Google Chrome. This works since this is part of Google Hangouts. This does work best in Google Chrome. So great, thanks, folks. Glad to hear it. Thanks for letting me know that the audio is coming through okay. Glad to know that. So I'm going to get us underway here now that we have folks in the room and we're ready to go. I have a lot to teach you. I'm really excited about this, in part because of the education end, what I have to teach you. But I have to, I don't like starting necessarily with sort of like the negative, the bad news, if you will. So bear with me, because it's a problem that is dramatically impacting middle-class America and other countries as well, and it's not getting the attention that it deserves, and it's called the retirement gap crisis. So as we get underway here, I'm going to start talking about that first, give you some of the sort of the statistical issues that we as investors have to be aware of when it comes to our money and our retirement. Retirement is not the end-all be-all. Granted, we have other things to do with our money. So we'll get to that, though, in just a minute. To get underway, I do have to make the lawyers happy, so please bear with me. U.S. government required disclaimer: Forex future stock and options trading is not appropriate for everyone. There is a substantial risk of loss associated with trading these markets. Losses can and will occur. No system or methodology has ever been developed that can guarantee profits or ensure freedom from losses. No representation or implication is being made that using the Millionaire Blueprint methodology or system or the information in this presentation will generate profits or ensure freedom from losses. Hypothetical or simulated performance results have certain limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors, such as lack of liquidity. Simulated trading programs, in general, are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profit or losses similar to those shown. There we go. All right, the lawyers are happy. Excuse me. If you enjoy watching paint dry, grass grow, or water boil, you are welcome to listen to that again on the replay and see if I missed any words. Just kidding there, folks. Just kidding. All right, let's get going with the retirement gap crisis. What the heck is it, and are you at risk? First of all, what is the retirement gap crisis? It is the retirement gap is the difference in the amount of money between what you have today in retirement savings and how much you will need for essentially whatever you want your standard of living to be in retirement. And generally, the statistics that I use are based on average standard of livings, average middle class standard of livings. We're not talking about vineyards, private islands, private yachts, Wolf of Wall Street parties, anything of that nature. We're talking about just standard Main Street USA kind of retirement here. And what we have found, and what we continue to find, is that that gap is not only significant and sizable for most investors, it's also growing. And it's growing every single year. Let me give you an example of the retirement gap and how challenging this is for investors and why it's important to understand this problem today. The average household income right now in the United States is $52,000 a year. Assume the average person retires at 67 and lives about another 15 years. So just to have that average or maintain that average standard of living in retirement, you'd need at least $780,000 in pre-tax dollars. Now that's if you were to sort of just every year wipe, you're gonna zero out your money by the time you die, and of course you're gonna live exactly those 15 years. That's how much money you would need, $780,000 just for retirement. That doesn't account for things like buying a home, putting kids through college if you're still young, if you still have kids, vacation or travel or anything that you want to do in retirement. It doesn't account for future medical expenses, which are right now the fastest growing expense for retirees. So on the face of it, the reality is that you're going to need much more. And most people are ill prepared for that. The 2008-2009 collapse in the stock market absolutely wrecked portfolios, especially for Gen X and baby boomers, younger baby boomers, forcing them to catch up. We'll talk about that a little bit. But what I'm going to be working with here is from the following premise, and I want you to understand why it is the premise. Our goal is to help investors become millionaires. I realize that's a big goal. It may be a crazy goal. Maybe it's psychotic of us. But when you look at that number for retirement, you're going to need at least $750,000. We're overshooting a little bit. That's why we make it our goal. That's why we target, and that's why we call this the Millionaire Blueprint, is to get people to have that portfolio value of $1 million so that no matter what, they can have worry-free and secure retirement in their later years, among other things. So for you may be asking yourself, okay, well, why is this so important to me today? Well, that's because 65% of Americans have portfolio values of $50,000 or less saved for retirement. $50,000, which means that the average retirement gap right now is greater than $750,000. So for most investors, the reality is that they are facing few to no choices for low-risk investments, meaning almost all of their portfolio weight winds up on high-risk investments. Now, I don't know about you, but high-risk investments usually only end up one way, and it's not a good way. Now, as I said earlier, the losses in 08-09 really hurt baby boomers and Generation X, forcing them to catch up, oftentimes with disastrous results. And most importantly, time is now working against everybody. It almost doesn't matter how old you are or how young you are. Those 50-year models, they're no longer applicable. They don't work. Because when we look at whether it's the ongoing jobs crisis in this country or any other, the income changes in income, debt levels, the value of homes, etc., everything has changed in the last 5 years. Most of it not for the better. So you have a lot of work to do. And if you think you're going to sort of be able to park your money in so-called safe assets and be okay, no, you're not. And here's the proof. Here's why you're not. People may talk about, may be afraid of the stock market collapsing. I don't know if you've paid attention or not, but bonds and CDs have collapsed far worse than the stock market did in 2008, 2009. And here's the fact. The stock market has actually come back. Bonds, CDs, savings accounts, they have not come back. In just the last 5 years, interest rates on jumbo CDs down 86%. U.S. Treasury bonds, safest investment on the planet, yields down 57%. So those that's what I was referencing on the last slide here. These low-risk assets taken away from you as an option, as a way for you to generate income in retirement or actually have a low-risk part of your portfolio to grow your portfolio. Can't do it. You can't do it on 0.25% or on 2.2%. It's not going to happen. Which means that stocks, unfortunately, for many people, still represent the best and still the safest way to grow your portfolio. And if you can understand that the entire market in and of itself is no longer strictly buy and hold. Now, that doesn't mean that buy and hold is dead. That's not what I'm saying. What I am saying is that all of your money in the market can't be buy and hold, because you will run into another 2008, 2009 at some point in the next decade or two. In part, that's because such things like high-frequency trading, computer-based algorithms, computer-based trading, excuse me, algorithms, etc. All of these things, they've created a trading environment, not an investing environment. Remember, 20 years ago, you were buying a piece of a company. You wanted to own a piece of a company, right? Remember the old Prudential commercials, own a piece of the rock? That was the idea behind investing. You owned a piece of that company. It's no longer that the investing landscape is gone. It doesn't exist that way anymore. It's a trading landscape. It's a stock picker's market. You're in for the gain, and hopefully you're out with the gain. So you have to change. You have to come up with you have to make a couple of small changes. They're not hard. They're not high risk. I'm going to show one of those changes that you can make here to you tonight, or you risk falling further and further behind. And what I'm going to teach you tonight over the next 30 minutes is a powerful yet still very safe strategy that you can use to grow your portfolio at an average rate of 7% per month. And what I'm going to teach you are these three things. First is a unique hyper-compounding investing plan that could turn $10,000 into $1 million in less time than it takes most people to pay off a car loan. I'm going to teach you a simple rules-based strategy that automatically secures investment gains and prevents portfolio wrecking losses. And I'm also going to teach you the one number that you must know to find the best stocks and use it also to avoid the worst stocks. And let me explain why those three things will work for you and why they're so important. We recently surveyed investors and found that essentially the top 5 challenges of investors out there, and 70% struggle to find the right stocks to buy. 55% don't have a good strategy. 62% don't know how to prevent losing money. 61% don't know when to enter or exit a trade. Yes, I'm recording this. Don't worry, I've got your back. So what I want to do right now is, based on those three things that I'm going to teach you tonight, hyper-compounding strategy, simple rules-based strategy, and the one number that you need to know, I want to show you 4 separate real trades to show you what's possible and how to solve certain problems so that you're not afraid of the stock market, so that you can so that you can participate in the stock market in the trading sense rather than just in the buy and hold sense, and that this is doable, that this is realistic. So we're going to talk about finding the right stocks to trade, following a good strategy, eliminating emotional interference. I'm going to cover that here as well, preventing losses and knowing when to enter and exit. And let's start out with a little company called Emergent Biosolutions. Stock symbol is EBS. I want you to look for 2 things that are going to be very common among all of this, the next 4 trades that I'm going to show you. The first is the gain on each of these trades. The second is the amount of time on each of these trades. This is the one change that you'll need to make to your portfolio. It is not hard. You can do this. I'll show you how. But here's Emergent Biosolutions. We executed this trade back in January at the beginning of this year. So this is a 2014 trade. And you can see over the course of a couple of months, the market was up, the stock was down, market came back up. We hit a 20% profit target back on March 7th. Next stock is On Semiconductor, another relatively small company. These are not penny stocks. These are not micro caps. Both of these were a little smaller cap stocks, but you see the prices here. They're $8 stocks. The other was a $28 stock. So certainly a $23 stock, excuse me. So certainly not high risk stocks here. You'll see that again in the next 2 stocks as well. But here's another one. We made this trade in February of this year. Opened the trade at the beginning of February. You can see a nice little jump up, a little bit of range bound action there through the month of March, and then finally in April another ramp up at the end of the chart there, and we hit another 20% gain on April 10th of this year, just over 2 weeks ago. The next stock is Micron Technology. Again, this was a little longer of a trade. We entered this back in December, and you can see again, stock moved up. We hit a 20% gain on April 22nd, so just a week ago. And finally, Goodyear Tire. Again, another well-known name, another large stock. Bought into this one on February 3rd, again, of this year, and you can see big movement up, and finally hit a profit target of 20% on April 24th. So you should already see the two most common traits behind each of those 4 trades. And here's what they have in common for you. First, they're all short-term trades that lasted 2 to 4 months. Each of them was a momentum trade that captured realistic and consistent 20% gains. All 4 of those trades followed a rules-based strategy, which I will teach you tonight, to automatically secure an investment win. And finally, every single one of those stocks was selected using the one number that you must know to choose the right stocks. And I'm going to teach you how to find that one number. It's dead simple. But if you can use this exact blueprint that I'm about to teach you, in the next 12 months, you could turn $10,000 into over $22,500. That is a 125% annual return, and I have some fun ways for you to do that. But more importantly, you'd never put your entire portfolio at risk. And I'll show you how, I'll show you why as we get through here. First of all, who am I? Why am I telling you this? My name is John Hutchinson. I'm the creator of the Millionaire Blueprint and the $1 Million Portfolio Blueprint and the Millionaire Blueprint investing strategy. As I said, I've been doing these webinars for the last 4 days, so you're going to have to forgive me. I'm losing my voice, and I'm probably losing my mind. I'm also the author of The Wealth Shield, How to Invest and Protect Your Money, which you can find on Amazon.com. I'm a publisher here at Traders Reserve and Main Street Investor, and best known really as an expert in wealth building and financial freedom who helps people restore their retirement dreams. I do that by protecting wealth, avoiding risky and get-rich-quick schemes. So you're not going to find any get-rich-quick stuff here. This isn't real estate speculation. This isn't Forex. This isn't day trading. As I said earlier, this is not penny stocks. These are not high-risk stocks. We are talking about the stock market, but we are talking about it in probably in a way that you're not used to, or unless you've seen this webinar before, a way that you may not expect. So I'm going to dive right in, but I want to start with the #1 mistake that investors are making today. Despite the fact that the market has come back over the last 5 years, most investors are still following the exact same investing models of the last 15 years. Now remember, we talked earlier about the retirement gap crisis and how if you have, say, $50,000 or less saved today, you have a long way to go to get to a point where you'll have a secure, sort of worry-free retirement. Again, I'm not talking about being rich in retirement necessarily. You can certainly aim for that. There's nothing holding you back from that. I'm just talking about being able to survive retirement without having to eat dog food. Most people are extremely far from that goal. And the reason is because they're following the same investing models of the last 15 years. And in that 15 years, the average annual return for investors is less than 3% per year. 3. Future returns, based on typical economic outlooks and rosy forecasts, are forecasted at 7% per year, which probably sounds really good, right? Except, here's a little mathematical fact for you. You can put $10,000 each and every year into the stock market, $10,000 a year, every single year, for 30 years. And it would still take you that long to get to $1 million portfolio. That's if you put $10,000 into the market every single year for 30 years, and if you get that 7% every single year for 30 years. Not only are too many ifs in that statement, but the reality for most investors is that they don't have 30 years. But if you're starting with $50,000, you might think you're in the catbird seat. Hey, it's not going to take me as long. You could put $10,000 a year into the market on top of your $50,000 every year for the next 15 years, and at that same 7%, you'd still have a 50% retirement gap. You'd still be short by over $350,000. But in 8 years or less, with what I'm about to teach you tonight, this could be your portfolio. I understand that I'm talking about $1 million. I realize you are going to be skeptical. Don't worry about that. Please feel free to ask questions as we go along. We'll do Q&A at the end, but I will show you how this is possible over the next 27 minutes. It's called the $1 Million Portfolio Blueprint, and its basic premise is that investors can no longer just buy and hold. Again, doesn't mean that buy and hold is dead, but what I'm going to teach you is how to use short-term investing in stocks to accelerate returns by compounding your gains monthly, not annually, monthly. And as you see in the little pie chart there, we're not using your whole portfolio here, are we? You take out a little slice of that portfolio pie, and that's what you use as your short-term investing capital, and that's it. You don't have to bet the farm. You don't have to take stupid risks with your money. We don't recommend that. We don't advocate that. You can still have long-term investments. You can still have medium-term investments. You can still have trading accounts, but you take one little slice out of your portfolio and dedicate it to this strategy, and what you'll find is by using just that little part of your overall portfolio, you'll get explosive growth of your money, but you'll still keep your portfolio safe. And that brings me to a quick lesson, which is that the key to successfully growing your portfolio is determined by increasing the annualized rate of return on your money. A couple quick notes, folks, just so you know, I apologize, I cannot, because of the way that this webinar runs, I can't keep up with some of the Q&A in the box. So yes, this is live. This is not recorded. Just so everybody knows, I can't keep up with the Q&A box at the same time that I'm doing the presentation, simply because I have to have two different screens. So I apologize for that. For any reason your screen is not clear, please resize your window, make it a little larger. I am maxed out on my screen, and I'm on a desktop, so hopefully that will get a little bit bigger or better for you. I'll do my best to keep it as clear as I can for you. Just happened to see that one question as I was moving something around here, so I apologize for the break in the action there. So let me go back again to an important lesson for investors here. The key to successfully growing your portfolio is determined by increasing the annualized rate of return on your money. This is the power of hyper compounding. This is the strategy, the first of the three strategies I'm going to teach you. When you put all three of these together, this is how you can ramp up. This is how you can grow your money faster than you ever thought possible. But this is the first step to understand. And I'll do this with a linear example. Apologize for that, but just you want to see how quickly these numbers can add up for you. So let's assume for a moment that you're starting with $10,000 and you get an average return of 4% per month. After 12 months, you'd have $16,000. That gives you a total annual return of 60%. But if you follow this exact same strategy for a second year, after 24 months, you'd have $25,000, and you will have increased your annual return from 60% to 78% per year over those 2 years. And you would have more than doubled your money in just 24 months. That's the power of hyper compounding. That's the power of compounding your returns, your gains, on a monthly basis. And the reason it's so powerful is because the money you're going to make next month is based on, or is growing because of the money that you just made this month. So what we'll be teaching you in this as part of this hyper compounding strategy, and along with the rules and the plan that we have put together here for you tonight, is how to do exactly that. How to start compounding gains monthly, but you're not using your whole portfolio. You're not putting your money at substantial risk. You're still keeping your money safe, and I'll show you how. I'll show you why as we get through this. But more importantly, you still get the opportunity to grow your money fast. And the faster that you can grow your portfolio, even a small segment of it, the more rapidly you're going to be able to close that retirement gap. I want to make one more point and remind you that this is not day trading. We are talking about short-term investments in stocks or other assets that are held that typically between 1 and 6 months. So you don't have to be glued to your computer, chained to your desk kind of thing. What we're targeting here, again, are compounded monthly gains instead of annual gains. And we're targeting a goal of between 2 and 8% returns every month. And then when you compound that over the course of 12 months, that would give you a targeted annual rate of return each year of about 80%. And if you can reach that number, or even be close to that number, then over the next 8 years, you'd be able to turn $10,000 into more than $1 million. That's because you're going to make more money faster with just part of your portfolio using short-term investing, using the principle of hyper compounding, and with these goals in mind, and you'll still never risk losing it all. And I'll show you how right now. We're going to get to that in just a second, because it brings me to deadly mistake number 2, which is that hope is not a strategy. Now, there are 3 emotional killers out there for every trader, every investor. We all know about fear. We all know about greed. But nobody ever talks about hope. And I'll show you why hope is such a killer. But in order to be successful as a trader or as an investor, you must have three things: a simple, repeatable plan to come out ahead, easy to follow rules that don't take a lot of time, and a smart way to protect your money. So let me illustrate what I'm talking about. A number of years ago, one of my mentors and I were taking a trip to Las Vegas. He was sort of a semi-professional gambler, and on one of those trips, I just asked him, sort of point blank, why do most people lose money in Las Vegas? And he said, people lose money because they don't have triggers to quit. I have two triggers, a profit trigger and a loss trigger. Whichever one I hit first, I pull that trigger and leave the tables for the night. Well, later on in my career, I started thinking, you know what? It's the same principle when you invest, isn't it? You have to have triggers. But here's the truth. Most people don't have a loss trigger, do they? When they buy a stock and it goes down, what do? They just hope it comes back, right? That's called the hope trigger. They just hope the stock will come back up. And they don't have a profit trigger. When a stock starts going up, what happens? They just hope it keeps going higher, right? Yeah, keep on going. Yeah, go, go, go. It's a recipe for disaster, and it's what wrecks investors' money. The key, though, to any successful trading strategy is to use triggers to remove emotion from the equation. Those three killers: fear, greed, and hope. When you learn to use profit and loss triggers to establish your profit target and your risk in advance, you automatically secure an investment win and protect yourself from a big loss. And the reason is because with these triggers, your decisions are made before you ever put your money into the stock market. You're making your decisions about your targets, what you're going to protect where you're going to protect your money, and what you're targeting as a profit before you commit your money to the market. So let me walk you through the rules-based strategy that I referenced. So you've seen the hyper-compounding strategy. Now I'm going to show you the simple rules. They're called the 2010 rules to investing. They're part of our $1 Million Portfolio Blueprint. I'll give you more details on that in a few minutes. But as I explained at the top, one of the changes that investors have to make, if they have any hope really of closing that retirement gap, is to learn to use short-term investing to rapidly grow just part of their portfolio. Not your whole portfolio, just a part. Yes, I'm going to drill that into everyone's head until they say it in their sleep. So in our model, we recommend roughly a maximum of 10% of your overall portfolio. The larger your portfolio is right now, the larger the percentage you can use, up to about 10%. Generally speaking, we see most people starting with around $10,000. The obvious reason is in the next bullet point, but we've seen people do this and do it successfully with as little as $2,500. But the next step is one of the critical parts here to the capital of the strategy, the capital management of the strategy, and that is to divide your short-term investing capital into 10 capital groups or buckets. So for example, if you have $10,000 as the amount that you're starting with as your short-term investing capital, the first thing you would do is divide that into 10 capital groups or buckets of $1,000 each. Then you would use one bucket to buy one stock at a time. So each bucket or each basket is holding one stock, so you're going to hold a maximum of 10 stocks at any given time. But what this does, by breaking that little portfolio segment down into a group of 10, is it reduces your overall risk exposure. It ensures that no single stock can ever take down your whole portfolio. And the reason for that is based on the triggers that I'll show you on the next slide, is you'll be able to limit your risk on any trade to just 1% of your overall short-term investing portfolio, and that's well within standard risk management practices or tolerances of 2% or less. So you're taking on very small risk, but you'll see this. You've already seen, in fact, the 4 trades that I showed you, the very substantial potential rewards. Part of that is due to our triggers, which are based on our 2010 rules. They should be relatively obvious. We use a profit trigger at 20% above our entry price to secure an investment gain on any stock we're trading. You can do that with a sell limit or a price alert at that profit trigger, but the most important part of that equation is to make sure that you take your gain, that you put that money back in the basket, so to speak, and then you repeat it the next month with another stock, the next month with another stock, the next month with another stock, and that's how you compound gains monthly instead of annually. And when you're targeting 20%, bear in mind that we're looking at stocks that we're going to hold, and typically anywhere from 2 to 4 months. Those 20% gains happen frequently. They're both consistently, they happen consistently, and they're realistic gains. We're not talking about pie in the sky, outrageous returns of 500 to 1,000%, those ridiculous home run trades that most people never hit. I'm talking about moves that happen in the market almost on a weekly basis. I've shown you 4 of them, and I'm going to show you a few more as we get through this next slide, this next set of slides. But at the same time, the key here with that profit trigger is to make sure that you never ever give back a gain. Don't let a stock get up 20% and then collapse on you. Take that 20% gain, roll that capital into another trade the next month or the month after or whenever, take another 20% gain and compound your money much more rapidly. That's the hyper compounding strategy. Now you also have to protect your money. And to do that, we use a 10% loss trigger. That's 10% below our entry price. And what that does is it ensures that, if for any reason something is materially wrong with the stock, fundamentally changes about the stock, even technically changes about the stock, we don't want to see a 10% loss suddenly become a 20, 30, or 40% loss, leaving us hoping the stock will come back, right? Take the small loss. You're preserving 90% of your capital. Cut your losers sooner and faster and smaller, and you'll have more money to make with the winners. In fact, with this 2-to-1 risk to reward ratio strategy, you can lose on a trade and be ahead by winning on your very next trade. You don't have to win every trade. You can cut losers fast and preserve your capital so that you have 90% of your money to trade on the next trading event. That's the key. That's the reason behind those loss triggers. That's the reason that most people actually lose money, is because they don't protect themselves. They don't make a decision to preserve capital on a trade. And so when it goes against them, they don't just lose, they lose more and more and more. And it's exactly what happened to investors in 2008, 2009. And that's why most investors cashed out at the bottom, because they didn't have a loss trigger. They didn't have a way to protect their capital or preserve their capital, and that's what that one little thing does. But that loss trigger, combined with the one capital division tactic of dividing your short-term capital base into 10 capital groups, when you put those two pieces together, that's what limits your risk to 1% of your short-term investing portfolio. So standard risk management, excellent risk to reward, realistic gains, consistent gains, and a realistic time frame to accomplish them, combined with a hyper compounding strategy. We're 2/3 of the way there. Now, in just a moment, the next piece that I'm going to talk about is how to find the right stocks using the one number. So bear with me and we'll get to that. But what you're going to learn, or what you should be learning at least by what we're talking about so far, is not to be afraid to hit singles and doubles. Winning in the markets is just like playing baseball. You'll score more often and win more games by consistently hitting singles and doubles rather than swinging for the fences at every at-bat. Hey, everybody loves the home run trade. I'm not going to lie to you and tell you I don't. I love the home run trade. You know how many I've had? 2. You know how long? In how many years? 26 years. So guess what? They don't happen all that often. I like singles and doubles. Singles and doubles start rallies, and rallies win baseball games. That's my view. But in a few minutes, what I'm going to do is tell you how you can get your hands on the $1 Million Portfolio Blueprint, which details the short-term investing plan I've just taught you, along with the 2010 rules, which I've also just taught you. But as I said, there is a missing piece, and that missing piece is the right stocks. And normally at this time, I bring in my partner in the Millionaire Blueprint, Jamie DeLugas. If you don't know Jamie, he's a 25-year stock market veteran and investment professional. Harvard Financial Digest previously ranked as Rational Investor a #1 newsletter. He currently writes for investment websites including Traders Reserve, MSN Money, MarketWatch, TheStreet.com, and others. And he's also the author of Manipulators, Beating Wall Street's Earnings Game, which is due out in May on Amazon.com. Sorry. So here's how we find the right stocks. This is our process. We run a computer-based algorithm which ranks stocks at the end of each month. In fact, we're doing it right now. We then review those stocks by sector and market cap to avoid overexposure to any one sector or to any one market capitalization group. We use a qualitative analysis process to re-rank all of those stocks into a top 10, and from that top 10, we select our top 5 stocks each month. Those 5 stocks are selected based on one number, which we use to identify the right top 5 stocks to buy. And that number is what we call the PE gap. A PE gap stands for the price to earnings gap. And those gaps occur, what we find is that frequently a price to earnings ratio and an earnings growth rate can get out of balance. Now, that's where those gaps occur, when they are out of balance. Now, by out of balance, I mean that the PE ratio can be greater than the earnings growth rate, which is a bad thing, or the price to earnings ratio can be less than the growth rate, the earnings growth rate, which is a good thing. I mean, that's an undervalued company. The wider that gap, the better the trading opportunity, because what we have consistently found is PE gaps trigger 15 to 30% returns in short-term investing timeframes. And those gains of 15 to 30%, you can see they wrap right around our 20% target. So when you put those pieces together, you see how the puzzle starts to fit perfectly. Well, here's an example of a recent trade we recommended back in December. This company is Manitowoc. The stock symbol is MTW. If you don't know the company, they are a Wisconsin-based heavy crane developer or producer. And they were leveraged really to the fourth quarter recovery in construction last year. Now, we made this recommendation after running our model at the end of November for a trade to take place at the beginning of December. So at the time that we made this recommendation, the stock had a price to earnings ratio of 16 and an earnings growth rate of 19, which gave us a -3 PE gap. So when the PE ratio is less than the earnings growth rate, that's an undervalued company or a buying opportunity. So here the PE gap is negative, which means it's undervalued. So we wanted to buy this stock at current prices. You can see here on the chart, we opened that trade at the beginning of the month of December, on December 2nd at $20.59. And now I've shown you a longer time frame on this trade, and I'll explain why in just a moment. But the most important circle is that very first one on the step up, and that is the profit target of 20% being hit on January 10th. So you can see, again, within 30 days, I showed you earlier, most of those trades earlier were between 2 and 4 months. So here's a trade that took about 30 days. But what we also see is that these trades continue to run. Upwards here, 50% over the next 60 days. Another 30% gain on top of that 20%. So this is how powerful this PE gap methodology is, because what it finds are stocks that Wall Street is not paying attention to. And it finds them because Wall Street is pricing stocks 6 months down the road. So when there are fundamental material changes in a company's earnings growth rates, in their earnings outlooks, in their essentially in their operational outlooks, or in their sector, Wall Street has to reprice those stocks. And oftentimes, what we're trying to do is take advantage of the fact that Wall Street has to reprice them in our favor on the long side. I'll give you some more examples as we work our way through, but let me show you how simple this is to calculate. I mean, you can literally do this at home. You need 3 numbers. The first is the current stock price, the second is the earnings estimate for the current year, and the third is the earnings estimate for the next fiscal year. You can get these numbers from any financial portal. The example you're looking at here is Yahoo Finance. At Yahoo, you can simply type in a stock ticker symbol on the finance page. Once that comes up, look down the left side menu, you'll see analyst estimates, and that'll bring you to this page. And in my example here, this is a recommendation. It's a little bit of an older recommendation, so bear with me. This is Insys Therapeutics, a recommendation from last September. But at the time that we did this, you can see the stock price was $36.24. Current year earnings were $1.06. Next fiscal year earnings were $1.67. Now, all you have to do, once you have those 3 numbers, 2 quick and simple calculations. First, calculate the PE ratio by dividing the price by the current year earnings estimates. So in our example here, that's $36.24 divided by $1.06, which gives us a price to earnings ratio of 34. Next, calculate the earnings growth rate by dividing next year's earnings by current year earnings. In our example here, that's $1.67 divided by $1.06, which gives us 1.57. You subtract the 1 so that you get a 57, essentially a nominal 57% growth rate. The last step is to simply subtract those 2 numbers, one from the other. So you subtract the earnings growth rate from the price to earnings ratio, and that gives you the PE gap. Now again, gaps can be positive and they can be negative. Negative gaps are what we are targeting, because negative gaps tell us that a company looks to be or appears to be undervalued. It's one of the final steps we take before we actually make a recommendation on a particular stock. So here in our example, we had a PE ratio of 34, an earnings growth rate of 57. That gave us a PE gap of minus 23, which again, the gap was negative, so the company was undervalued. You want to buy the stock at current prices. Now, what I want to do here is bring together the 2010 rules with our profit and loss trigger and show you how all of this can work together for you. So let's do our 2010 rules in action with this recommendation. Or we would have made this recommendation at the end of August, so you would have bought the stock at the beginning of September. Now, in our program, we enter trades at the beginning of each month. In essence, we're not market timers. Our model gets run at the end of the month, so that's when our output occurs, and that's when we're able to make our 5 stock recommendations. So we jump right on the very first trading day of each month. So we're actually going to be making our next recommendations here tomorrow night for entry on Thursday, May 1st. So we're getting ready right now to make our next 5 stock selections using the same process that I'm teaching here right now. So here's how the rules work now when you have the stock recommendation. Here's how the rules work with it. So you would have entered at the market open of $28.98 on September 3rd. First 2 steps are to make your decisions before you're committing or as you're committing your money to the market here. And those decisions are your profit trigger and your loss trigger. To get your profit trigger, you simply multiply your entry price times 1.2 for a 20% profit target. So $28.98 times 1.2 is $34.78. That's the profit trigger. Next, enter your loss trigger. That's 10% below your entry price, or multiply the entry price by 0.9. So in our example, $28.98 times 0.9, that's $26.08. That's the loss trigger. Let the market do the work for you. You've made your decisions. You've set a ceiling. You've set a floor. Let the trade run to conclusion. Here's what happened. This one was a rarer instance, a much faster moving trade. It took about 5 days to hit its 20% target, but it did on September 9th. And actually, if you look this stock up, I don't know where it's trading today, but more recently, it had been trading up in the $90 range. So again, another example where a PE gap not only identified a fast-moving 20% gain, but you could have held this for a medium term, part of that medium term portion of your portfolio, for upwards of a 50 to 60% gain. So again and again, the PE gap works to find these types of undervalued companies where Wall Street has to reprice rapidly in order to get those earnings, growth rates, and price to earnings ratios back in balance. Let me do another example here, and then I have one more for you after this. This is Southwest Airlines. This was an October recommendation, which we made right in the teeth of the budget fight. The government shutdown and the debt ceiling limit back in October. At the time, Southwest Airlines had a PE ratio of 15 and an earnings growth rate of 17.5, so it had a PE gap of negative 2.5, meaning the company was undervalued. Let's put the rules in action again. We would buy this stock at the market open on the first trading day of October, which was October 1st. The price that day was $14.56. First step, calculate your profit trigger, so $14.56 times 1.2 equals $17.47. There's your ceiling. Next, calculate your loss trigger. So $14.56 times 0.9 equals $13.10. There's your floor. You've made your decisions. You've set that ceiling. You set that floor. Let the market do the work for you. Let the trade run to conclusion. And here again, another 30-plus day trade where we were able to take our 20% gain. I think it was 38 days, 36 days. So very rapid movement in this particular stock. The airlines sector has been doing very well, with the exception of United Airlines. Overall, many of those stocks are still undervalued. Many of those stocks are still potential buys, even right now. I'm going to actually show you another one in just a minute. But also using an advanced profit strategy that we teach members, you could have let this stock run for an additional gain of 7.5% on top of that 20% gain. I'll give you more details about that a little bit later. But again, note, time and again, now every trade, now let me make sure that it's clear, every trade is not going to be a winner. That's why we have that loss trigger in place. But what we're finding is we're getting more than 60% of our trades right. And over time, that's going to ramp. That's going to help you make up that retirement gap, because your money's going to grow explosively when you're compounding gains on a monthly basis instead of on an annual basis. But let's take a look at an open trade recommendation. This is American Airlines. This is a stock that we recommended back in February of this year. And I'm going to show you a couple of different charts here, not charts, but graphs like you're seeing here. And first up, I did this last week. This is the current number. These are, the current numbers for the PE gap methodology on American Airlines. I'm going to show you the numbers we used when we made this recommendation on the next slide. But I want you to see how this is still a company that's actually, this could actually still be a stock recommendation even right now. So the company had, as of last week, it had a stock price of $37.23. Current year earnings estimates of $4.78. Next year estimates of $5.60. So again, calculating our PE ratio, 37.23 divided by $4.78 gives you a PE ratio of 7.8. And the earnings growth rate, $5.60 divided by $4.78, gives us an earnings growth rate of 17.2. So we have a negative 9.4 PE gap. So again, an undervalued company. You could buy this stock at current prices, apply those 2010 rules. I think the stock is probably trading around 35, 36 right now, so you'd get even a better discount than what you're looking at here, and that PE gap would be even wider than it currently is right now. But when we were looking at this, when we made this recommendation back in February, the price was $33.55. And I've listed here, we had 13, 14, and 15 earnings. We looked at this a couple of different ways because you could see the numbers were dramatically different from year to year there, $2.91 to $4.47 to $5.03. But note also that, I just showed you, let me go back a slide here. Again, look at on the right side there, you've got next year earnings. This is a snapshot taken last week. 2015 earnings, $5.60. Remember that number, because note on this page, this snapshot was taken back at the end of February, and look at the difference now of those earnings for 2015. At that time, 2 months ago, they were $5.03. So this company has already had its earnings estimates increased forward for the next year by 10%, by a little more than 10%. So this is what I'm talking about Wall Street now has to reprice this stock forward, for another 6 months forward, another 6 months forward. They have to catch up now. So this is why I would say that American Airlines is still a buy even today. But when we were looking at it back in February, we had a good price, $33.55, and at that time we had a negative 45 PE gap. And it still has about a negative 9, negative 10 PE gap. So the company is still undervalued. So even if we were using our 2010 rules from that February timeframe, assume we would have bought on February 3rd, which was the first trading day of February, at $34.04. That was the market open. Set our ceiling and our floor, so $40.85 and $30.64. Let the market do the work. Let the trade run to conclusion. And currently we're up just under 10%. Again, this is last week's chart, last week's numbers, so apologize that I haven't updated them for tonight, but we're still up about just under 9% on this trade, so about halfway to our goal. You can see we've been in the trade for just over 60 days. So again, in that 2 to 4 month wheelhouse for a short-term investment, another trade working successfully based on that PE gap methodology. And here are some other trades that we've had open over the last, that we have open, at the present time. I showed you at the top, Micron. We closed that April 22nd with a 20% gain. The 23.7 is because that was the open on the day after. The day that we were closing. So you could have been anywhere between 20 and 23%. Who's going to complain about an extra 3%, right? You can see on semiconductor, I showed you that chart at the top of the show, 20% gain. GT, a 20% gain. Whirlpool, currently about a 15% gain. Tesoro, up 10%. A couple of break-even trades. We have a trade that's down. So we're going to have the gambit, if you will, across the spectrum of trading opportunities. We're going to have trades that will not work out in our favor in the short term, and we have to preserve that capital, take that small 10% loss, roll it into the next trading event, and make it up with a winner on the next trade. But you can see overall, this has been this has been our experience, but more importantly, here's the track record since we began doing this back in August. But I want to make something perfectly clear. The PE gap methodology that Jamie has devised is one he has been using for over a decade. It is the combination of the rules, the 2010 rules, the short-term investing plan, and the PE gap methodology, which we put together back in the middle of last year. And then we sort of started putting this out for some of our members in August, and again in October, and every month ever since. And these are the results each month, by month, of the recommendations made for that month. So for August, 11%, 16% in October, 5 in September, 5 in October. You can see we had a great month in December. January was down nominally, despite the fact that the markets overall were down about 4.5%. We had a very good rebound in February. March was down a little bit with all of the geopolitical issues and the essentially the decoupling in the biotech and technology spaces in the latter half of the month. But March trades, we still have several of those open, so that number could certainly change. April, I think, is actually currently up 2.2% overall. I haven't updated that because those trades are still open as well. But what we're averaging right now is 7% per month, which is what I told you we would be targeting for you as part of this overall strategy back at the top of this webinar. And it's that 7% per month, which works out to a 125% annual return, which you can put together. When you put all of this together and you use this blueprint, that's how you could more than double your money in the next 12 months alone. And if you do this year after year, that's how in 8 years or less, you can turn $10,000 into more than $1 million and never have to worry about that retirement gap crisis. And that's why I said at the outset, I know it's kind of a crazy goal, but our goal is to help turn 250 investors into millionaires. Your goal, now that this presentation is coming to a conclusion, is to be one of them. And you may still be asking, all right, but why $1 million? And I'll remind you, average household income, $52,000 a year. If you live 15 years past the time that you retire, you're going to need $780,000 just for retirement. Doesn't include things like future expenses for medical issues, putting kids through college, buying a home, going somewhere other than Florida, for Pete's sake. So while many people may sort of call that goal ridiculous or may scoff at the idea of $1 million goal, the reality is it's a necessary goal. And the question is, how do I get there? Well, as I told you earlier, you're not going to get there with bonds. You're not going to get there with CDs or savings accounts. Stocks continue to represent the best way to grow your portfolio. But you must have a simple, repeatable plan to come out ahead, just as I've shown you here tonight. You need easy-to-follow rules that don't take a lot of time. This program is not day trading, and those 2010 rules, pretty easy to do. And you need that one number to buy the best stocks and avoid the worst. 70% of investors struggle to buy the right stocks. I've just shown you the one method you can use on your own if you own a calculator to find the best stocks to own. And it wasn't hard, was it? So right now I'm going to invite you to join the Millionaire Blueprint program. It is the only complete investing plan specifically designed to create millionaires. It includes the $1 Million Portfolio Plan. Just as I've shown you the details here, that entire plan, the rules of that plan, the 2010 rules, just as I've taught you here tonight, and the right stocks using the PE gap methodology, which again and again over 2 to 4 month time frames is consistently delivering 20% winners. Now, let me give you quick details because we are low on time, not only for this webinar, but also because tomorrow night at 7 p.m. We make our May stock selections. So this is a good night to get in. Each month, we make up to 5 new monthly trade recommendations. We make them at the end of the month, so that, again, they'll be out tomorrow night at 7 p.m. You simply enter those 5 trades on the first trading day of the month. So you want to enter by the market open on Thursday, May 1st. You follow the 2010 rules to investing. We'll supply you with additional trade alerts and exit alerts, so you always know what to do. You're never doing this on your own, and I'll give you more details on that in a moment. And when you hit those 20% gains, you bank those profits and simply repeat the process the next month. Now, there will be a deadline of 6:59 p.m. tomorrow night. I know that's a weird hour, but again, that's because the May stock selection report will be in your hands at 7 p.m. And there's another reason too, which is coming up in a slide here in just a minute. I will turn around and do Q&A in about 2 minutes, so just hold on, and I will get to all of those questions. But again, this is a complete program. As I said, first and most importantly, you get the complete $1 Million Portfolio Blueprint that includes the 2010 rules to investing. You simply follow the short-term investing plan, just as I've taught you here tonight. Remember, you're not risking your whole portfolio. You're just using a little piece or slice of the pie. So you keep your money safe overall, but you still get that explosive growth using the hyper-compounding strategy and the 2010 rules. Next up, you get the monthly Millionaire Blueprint monthly stock selections. Again, those selections come out at the end of every month. Top 5 recommendations are made. So what you'll see is the reason we do 5 at a time is so that we're never overcommitted to the market. We're able to step in month after month, depending on what's happening, if we want to sit tight, if we need to back off, if we need to hold off, if you will, because of market conditions, or there's, whatever happens that might be on the negative side, it gives us that flexibility to do so. So that's why we only want to enter 5 trades per month. So you get those top 5 recommendations tomorrow night, 7 p.m. if you join tonight. Especially, in fact, if you do join tonight, you're also going to get that the $1 Million Portfolio Blueprint report. You can print that out right now tonight so that you're ready to go tomorrow night. But on top of the monthly stock selections, we also have our members-only website. Everything you need is easily accessible in one simple place. Plus, beginning tomorrow night at 7:30, we're starting our 2-day live Millionaire Apprentice Boot Camp. These are 2 90-minute training sessions. The first one tomorrow night will help you to review and prepare your portfolio for the short-term investing plan. Use our capital management spreadsheets to track your 10 baskets. We will review your first monthly stock selection report and walk through the process of entering your first Millionaire Blueprint trades. Then Thursday night we'll come back for an additional session of about an hour to an hour and a half, where we will essentially follow up on the 2010 rules so that everybody's following the same process. Teach you to use those profit and loss triggers and how to follow our trade alerts when they come out. And then we'll also talk about ongoing trade management, because you don't really have much. We do most of it for you. We watch the market for you and we tell you when to act. And then what you can expect next as a member as we start going through the month of May. Now, I know a lot of people will say, well, sell in May, go away. Strangely enough, there hasn't been enough of a rally in April to justify selling in May yet. So we're looking for an interesting month in May. But you also get our trade alerts and regular updates every Tuesday and Thursday. We send out a simple sort of basic market overview and anything that's happening with any of our stock selections. For example, it's earnings season right now. So as each of our companies has reported earnings, we're also updating members on how those earnings reports are coming out, how they're affecting the PE gap, or how they're affecting the numbers overall for the company. So you get those on Tuesday and Thursday, and then every Saturday you get our Saturday review, which is a more robust look at each of the individual stocks in the portfolio, each of the recommendations, the overall gain or loss, if there happens to be one, and any action to take, just as you see on the screen there with the Whirlpool example at the bottom of there. If there's when we want you to put a sell limit order in so that you can take your automatic gains, we will tell you when to put those orders in. Same thing on the stop loss side. If we're getting close to a 10% stop loss, loss trigger, and you need to put a stop loss or a sell stop order in, we'll tell you when to do that as well. So you're never on your own. You have 2 mentors in this program, Jamie and me, and together we work to help you make the most out of every stock recommendation that we make as part of the program. Which is why we also have 2 bonus reports. Our Advanced Profit Strategies report. Essentially, it teaches you 2 dead simple strategies. One will help you to eliminate all risk in the trade, and the second will allow you to let winning trades run for larger gains, just like I showed you in the Southwest Airlines trade. And for those of you on a limited budget, we also have our $2,500 plan. That teaches you how to get from $2,500 to $10,000 in about 12 months or less, still following the Millionaire Blueprint stock selections, and the 2010 rules to investing. We also have our capital management spreadsheets. These are simple Excel spreadsheets that manage those 10 baskets for you. Pre-formatted formulas do all the math for you, so you don't have to do any work. And we also do updated training on how to use those every month. And last but not least is our Millionaire Hotline email. This is direct access to Jamie and me via special email account. So you don't have to go through customer service. You don't have to wait 24 hours to get an answer. Monday through Friday, 8 a.m. to 5 p.m. every single day, we're watching that email box and we're responding as soon as you email us. So if you ever need help with your Millionaire Blueprint selections, the 2010 rules, the investing plan, this is your lifeline for instant support. So this, the way that we do this program, quite simply, it's a 60-day trial. For $79, you get complete access to everything. You can keep all of the reports, the bonus reports, the $1 Million Portfolio Plan, the capital management spreadsheets. You can essentially take all the goodies and start learning to do this on your own over the next 60 days, or you can certainly stay and be a member as long as you would like. If you want to continue on beyond the 60 days, you can continue on for $79 a month, or we give you an upgrade opportunity every month to save a little bit of money and actually to extend your subscription for a full year. But more importantly is this: we know this program is not right for everyone. We know that many people are not familiar with the idea of short-term investing or hyper-compounding their money. So the best way to know if this is right for you is to do it. And you want to do it now, because time's, as they say, time's a-wasting. And you can't afford to wait 3 months, 6 months, 12 months more, because every year that you wait means you must double your money at some point in order to make up that difference in the retirement gap. So if you don't have a plan and you don't have a strategy to accomplish that, you will not be able to make up that money in the next 5 to 10 years. So this strategy can help you. I've taught you from the hyper-compounding to the rules to the right stocks. Essentially, you saw how all of those pieces work together. To get in, to reserve your seat right now, there's a box, should be a box in the chat. I'll put another link up here in just a minute as soon as I start doing Q&A, but you can go to millionaire-blueprint.com/join, J-O-I-N. That will allow you, you just click on the Get Started Now button on that page. That'll take you to the reservation form so you can reserve your trial seat right now. I know we ran a little longer than I expected to, so I will stick around and answer as many questions as I can for folks. I apologize that it took a little bit of time tonight to get through the presentation. As I said, I've been doing so many of these over the last 4 days that it's I wish I could say that I could do it in my sleep, but I'll be honest, I can't. So let me remove that, and I will put this link up. If you click on this link, just so you know, folks, you will get taken out of the webinar. That's okay. You just want to get to that page and get yourself signed up. Join. What? Millionaire Blueprint. I can't even read my own writing. Can you believe that? There we go. Join. Boom. All right, that better work. And display. There. All right. So no. Let's try again. There we go. One, two, three, four. That's better. All right, sorry about that. All right, let me scroll back and start taking some of these questions. So just give me a moment to get settled here, and I will stick around again and help as many of you folks who need it. Sarah says, I have a home care agency. You probably have no idea what home care will cost you. You can live 10 to 15 years needing help dealing with multiple chronic illnesses. We have clients who pay $150,000 for 24/7 care and home. Wow. Thank you, Sarah. That's a great statistic to know. Most of our clients are living into their 90s. Holy cow. You've got to plan for this. You'd better know how and when you will be spending your last years and know what you want to leave for your family. It's going to be very hard. Thank you, Sarah. Thank you very much for sharing that. It's a great point. That goes back to the whole, I'm only calculating based on retirement costs. I'm not accounting for things like medical costs or, as Sarah points out quite intelligently here, home care. It is expensive, and it's going to be even more expensive as we go through. Let's see. If you can start with $50,000, you get to a point of being unable to move shares in and out of the stock picks you recommend. Actually, Sarah, what I do in the $1 Million Portfolio Plan is I show you, as you start to get to larger accounts, how to break your baskets down into smaller segments, into more segments, so that you don't run into that risk of not being able to take advantage of trading events. So there is a plan, if you will. There's a matrix which shows you as you get to 100 or 250, 100, 200,000, how to break your portfolio down so that you can still take advantage of trades. So we do have a plan for that. With 20%, why not? Why 20%, not 25% or more, and keep 10% as the max stop loss? Good question, Brian. But the reason for 20%, number one, is because it's in that range of the 15 to 30% moves that we see happen within the time frame of 2 to 4 months. That those 30% gains, they can happen, but they, a lot of times they take longer. So remember, we want to be compounding our money as frequently as possible during the course of the year, preferably almost on a monthly basis. Now, it may not happen that way all the time. It might be every other month. But if you wind up waiting 5, 6, 7 months to get those 30 or 40% gains, you're not going to be able to compound your money as rapidly, and it won't grow as fast. I know it sounds like it would, being a 40% gain versus a 20% gain, but it's the time factor when you divide that back by the number of months that you hold a stock. So, for example, if you hold a stock for 4 months and you get a 20% gain, you made 5% per month. So now you still have 8 months left in the year to compound that 5% per month. If you hold a stock over 8 months, well, now you only have 4 months left during the course of the year to compound that stock. So the faster gains work more in your favor, but that doesn't preclude us, again, from having the opportunity to roll stocks up to our medium-term portfolio, which is something we're going to be teaching our members how to do starting in June of this year. Quick question on options. Quick question on options. We'll actually be launching an options module this summer, most likely in July. So that options are coming, but no, we have not been using options by and large with our recommendations. The main reason for that is because, number one, options are not for everybody. When we originally built this program, the Millionaire Blueprint program, we built it for really any level of investor, and typically newer investors should not be trading options. Younger investors really kind of shouldn't be trading them. Experienced investors are the ones who should be playing an option, so to speak. And the other part of the equation there is not every stock that we make a recommendation on is an optionable stock. They may not have the liquidity, they may not have viable spreads, so it limits the opportunities on the options side. So the module that we're going to be launching in July is a little bit different take, but it'll be a completely separate set of rules, set of targets, set of triggers, but it's still based, still has a basis in that PE gap methodology. So again, we'll be launching that options module in July. Bruce asks, can you please show all of your recommendations for the last 12 months? No, Bruce, because number one, quite honestly, the program has been running since August of last year, and that's 45 trades. I can't fit it on a screen. If you would like, you're more than welcome to email us at service@TradersReserve and request a copy of the track record. More than happy to send you an Excel spreadsheet which has that track record for you of the last 9 months of the program. Is the full list available and non-subscribers? Not yet, but it will be. We just finished the members website last week, so we do still have some holes in the content to fill in, which we'll be filling in once we get our May trades put out. That's our focus right now, along with the 2-day boot camp. We need to make sure that everybody knows how to get their trades running for the month of May. And I mean, that's the proof. Really, once you have once you have your money in on those 5 trades, that's where you're gonna prove everything to yourself. Not only about the stock selections, but also in terms of the 2010 rules. What about commissions? Do you consider these in your calculations? Yes, we do. Our capital management spreadsheets calculates commissions both on the front end and the back end, and in the advanced profit strategies report, I also show you how to account for commissions so that you are treating your portfolio as the business that it should be or is. So I actually teach you in my risk reduction strategy how to set a true break-even point, which accounts for trading commissions in and out on a trade. So you always know what your sort of your absolute 0 point is on any trade. So if a trade starts to run in our favor, but the market gets dicey, you can move a stop loss up to break even, which includes your trading costs, excuse me. So your worst case is you're out at 0. But you recover your trading commissions on the front and back end. So I teach you how to do that in the Advanced Profit Strategies report. That's one of the bonus reports that you will get as soon as you join. You'll get an email with a link to download it. You'll also get your access to the members' website immediately so that you can look right away for 2 emails. One is a subscribe, an email confirmation so that we know or that our email provider knows that you're a real person asking for access to the Millionaire Blueprint email list. But more importantly, you get your access to the members' website. You can get right in there, download those bonus reports, and the $1 Million Portfolio Blueprint. You can read all of that tonight, tomorrow. Take the day off from work if you want to, but you'll be ready to go for boot camp tomorrow night at 7:30 p.m. Eastern. Remember, the stock selection report comes out at 7 p.m. Boot camp is a half hour later at 7:30, so you'll actually have a half hour to read through the stock selections for the month of May and get yourself situated and ready to go for trading on Thursday. And then we'll come back and we'll do boot camp session number 2 on Thursday night. Does it work if the market is in a downtrend? Yes, it does. There are 3 reasons why it will work in a downtrend. Number 1 is because we can replace stocks with inverse index ETFs, commodity ETFs, currency ETFs, if we so choose. We actually have a short on in the bond market right now as a hedge against the stock market. So there are any number of tactics that we can use. There's also the opportunity you can go to the sidelines, not the sexiest of options, but it is a choice. Because not trading is in fact trading, so you can go to the sidelines if we so choose. That's one of the, when you look at that the pie chart of the portfolio, this is one of the most powerful aspects that I actually don't spend enough time talking about, and I'm going to point it out here just very briefly, and that is that when you have short and medium term allocations in your portfolio, if the market starts to get dicey, folks, that's 35% of your money that you can move to cash, that you can move to the sidelines and sit tight. Now, generally, going the Warren Buffett way, remember I didn't say buy and hold was dead. I just said you didn't want to be dedicated to buy and hold. So you can still have your long-term investments. You can leave them there. You can leave them. They're safe. They'll be fine. They'll come back. But you can move a portion of your portfolio to cash and sit out a bear market or a correction and wait for your opportunity to buy, not necessarily buy the low, but at least buy back in on the upswing. Something that most people don't think about. The reason that most investors lost so much money in 2008 and 2009 was because they sold at the lows. And they kept on selling at the lows. They didn't sell as things were getting bad. They didn't sell, when things were just, things were looking bad. They sold at the lows, which is exactly what what investors always do. They capitulate at the bottom. They are the bottom. Well, the problem with selling at the bottom is twofold. You have less capital to take advantage of a rebound, and the rebound always comes. I know it was dark there in September, but the rebound still happened. And more importantly, now you're afraid. It feeds that fear emotion. So, and anyway, moving on. So again, that's another way that you can play a correction or a downturn or a downtrend in the market. Remember, bear markets last on average roughly 6 months. Bull markets last much longer. On average about 10 years. So we're still in the early to mid stages of the current bull market. Let's move on to some other questions here. Ted, thank you for your time. Let's see here. What is the fee? I assume you have back tested this method. Actually, Lou, you can't back test it because you don't have access to the earnings numbers. And by earnings numbers, I mean the forward year estimates from prior years. So no, it can't be back tested. And not when you're, again, remember, this is a three-part strategy: the hyper-compounding, the 2010 rules, and the PE gap methodology. The PE gap methodology can't really be back tested unless you can get, you have to be able to get those historical earnings numbers, those historical earnings projections from the time that the stock would have been made. The stock recommendation, would have been made. So that's the data that's not available, and that's why it can't be. That's why we didn't back test it. We forward tested it. We put the recommendations out into the hands of subscribers and let them make money with them. I thought that was a much better way to do it anyway. And frankly, back testing is only good for technical models. This is not a technical trading model. When you're talking about fundamentals, you have an entirely different set of rules that apply to a stock. So you can combine technicals with a fundamental analysis, if you will, but when you're back testing is largely done through technical analysis. What was that email address again? service@tradersreserve.com. Randy, I'll put it in the little chat box for you here in just a second. And just shoot us an email and let us know. We're more than happy to help you. There you are, sir. Thanks very much. Hopefully that got to you. Where can we access the webinar recording? On this exact same page, millionaire-blueprint.com/join. There is already a recording from last night. Yesterday afternoon. On that page, should be at the top of the page. We're actually editing a recording, so it's a little shorter, but there's already a recording up on that page which you can watch on the millionaire-blueprint.com. That's in the admin notice box here. That's also in the pop-in box, so you can just click that button to get started, and that'll take you to it. What dates are the 90-minute trainings? Wednesday, April 30, and Thursday, May 1st, both nights at 7:30 p.m. Eastern Time. They are recorded. Those recordings will be available within 30 minutes after we finish. So by 9:30 p.m. Eastern Time, if you can't make one of the sessions, those recordings will be available for you to review on the members' website. Is there a maximum amount of members you accept into your program? Yes, there is. Where can we? Oh, I already got that one. And I'm sorry. Yes, there is, Justin, a maximum number. We have not reached it yet. So if we get there, then we won't let anybody else in. I guess that's the simple answer on that one. Isn't the number you were using to choose stocks called the PEG ratio? No, there's a similarity, but the PEG ratio is division. What we're looking at is the gap, the difference between the two, and the difference there is a little more esoteric than that. But we're looking at the hard number between the price to earnings ratio and the earnings growth rate, not the inverse relationship of one to the other, which is what the PEG ratio is. So next up here, do actual portfolios? No. Let's see. What was trying to find? Hang on just a second. If the chat box would stop moving on me. What do you do in a bear market? I think we got that one. Missed the beginning of the webinar. Can I view a recording? Yes, right on the page, millionaire-blueprint.com/join. That's the same, essentially the same presentation yesterday that I just did tonight. Only it's probably a little cleaner, and I had a better voice. Do you ever exit a trade if the expected move becomes stagnant? Yes, Ray. There are times where we will make recommendations to exit a trade early. Number one, those times may occur if a stock is moving the wrong way and something materially has changed with the fundamental outlook of the company. A couple of examples from January: we exited with a 3.9% loss and a 5% loss rather than sitting around and taking the full 10% loss. In one of those cases, a shipping company which is dependent upon China, that stock started to go the wrong way when China began to report disfavorable economic numbers at the end of January. So we advised members, take small loss, let's save our capital, and we did. We saved 96% capital and moved on to February, and February was an up month by 10%. So there's an example of where we made a good move. More recently, Owens Corning we had bought that one That was a December recommendation. I think our entry price was $39.78 to be exact. We actually recommended a week ago taking about a 6.5% gain on that stock. Our exit price would have been about $42.50 a week ago, and in part it was because Owens Corning had reported less than stellar earnings numbers. Number one. Number two, the housing market has not yet kicked into gear, in large part because of the weather, obviously the first quarter weather. So what the issue that we looked at was we'd already been in that trade for 4 months, and in order for us to extract 20%, we were likely going to have to be sitting in that trade for another 4 to 6 months, which is not going to grow your money, as I said earlier with my examples. So we opted to take a small gain. Let's free up capital for May. Let's put our money back to work with a different stock. We took a 6.5% gain versus 20%, but so what? We still walked away with money in that regard. We cut our losses shorter on another stock, on other stocks, as I showed you or discussed. Sorry, you get the point. Let's move on. There are hundreds of companies that would have earnings growth rate. Yeah, Bruce, but we're not doing a trailing 12 months PE. We're doing a forward PE. That's a big difference. That's the big difference. We're doing the 2014 price to earnings ratio. We're not doing a trailing 12 months price to earnings ratio here. So what you're looking at is this year's price to earnings ratio based on where the company is right now, and you're comparing that against the earnings growth rate of this year to next year, not last year to this year. The only time we're technically using last year's numbers is when we're trading in December or January and we don't yet necessarily have the year forwards numbers available to us because analysts haven't put them out or haven't made them. That's one of those reasons why when I showed you the American Airlines chart, remember we made that recommendation at the end of January, and if you had looked at that, we showed you, we had circled out the EPS trends, and every 30 days, 90, 60, 30 days, 7 days prior to when we took those snapshots, those earnings had been rising. By analysts. Analysts have been raising their estimates, and the reason was because it was still the first month of the first quarter of the new year. So earnings, there's fluidity in those numbers. They have to, the analysts have to work their magic, so to speak. So those numbers were rising rapidly as the month of January progressed. So again, it's not a trailing 12 months; it's a forward 12 months, and it's a forward 12 months versus a forward 24 months comparison of the earnings growth rate. That's why it's different than what most other people are using out there. Ooh, thunderstorms in the background. Excellent. I hope I don't lose power. What do you do? Price after trial, $79 per month, or you can upgrade. The upgrade price will be $497 for a full year, plus 2 bonus months. So you get 14 months for the price of 12 for $497. I forget what that works out to. It's something like $38 a month. Somebody can do the math for me on that one, because honestly, I'm too tired. Ted said, thank you for my time. I saw that one earlier. Cannot hear or read the print. Lewis, if you mean on the video on that page, on the millionaire-blueprint.com/join page, if you look in the lower right part of the screen where that video is appearing, there's a full screen button. It looks like 4 arrows pointing out. You can click that, and the video on that page will go to full screen for you. Am I following correctly? If you start with 10, you're investing 10%. Hang on, Ray. I'm trying to read that one. Ray says, am I following correctly? If you start with $10,000, you are investing 10% between the 5 or so picks each month. Actually, the 10% is about the maximum of your total portfolio that you should allocate towards short-term investing. So if you are starting with $10,000, then yes, each bucket is 10% of that $10,000. I'm sorry, I see your question now. I'm sorry, I understand your question now. I apologize, I misunderstood it there. So yes, you're breaking your $10,000 down into 10 individual buckets of $1,000 each, and then you're buying one stock per bucket. So we make 5 recommendations a month. Part of the reason we do a 60-day trial is you'll get 5 recommendations in the first month, 5 recommendations in the second month. So over the course of the next 60 days, you'll actually be a part of 10 total recommendations to fill all 10 of those buckets with one individual stock per bucket. And then simply apply the 2010 rules, let those trades run to their conclusions, and as they hit either their profit or their loss triggers, you're then rolling them over the next month into the next trading event. So that's you do have that right. I apologize that I misunderstood your question, Ray. My fault on that one. Just a few more here. I think we're getting up to the 9:30 hour. So let me scroll back up here to the top and see if I can work backwards. Didn't catch whole webinar. Could we move the -10s to 0 after our stock makes a 10% up move? Simon, it's a good question. I generally don't like moving that fast, especially in the current market environment. We're in a very tightly range-bound market, especially in the S&P, especially in the Dow and the NASDAQ, and we're consistently seeing stocks moving in the 5 to 7% range. So the problem with trying to move a stop loss too quickly up to that 0 or break-even point is you run the risk of getting yourself stopped out too early. It is a nuance. I generally don't want to see that stop loss moved up to a break-even point until we're above a 15% gain, because if a stock moves 15% down, something went badly wrong. And at that point, if you get out at break-even, you've done fine. We have seen a couple of instances where stocks have moved that violently, though. Micron was a great example. Was up 13%. During the course of one of those tech blow-up weeks, it lost 13%, so it went down to a zero gain trade, and then the very next week it rebounded the same 13%. So if you see what I mean, with some of these more volatile stocks, that's why you have to be careful, because if you move that stop loss too early, you're going to get yourself stopped. You will get yourself stopped out. Even if it's break even, sure, that's no problem. You didn't lose anything, but then that stock went on and hit its 20% target, so then you miss out on the 20% move. But a great question, Simon. Very, very good question. Thank you. What is the cost after 60-day trial? $79 or the $497 annual upgrade, your choice. $79 a month, excuse me. Joel, no, the PE gap formula does not work on ETFs. ETFs would be used really in a substantial downtrend. Like if everything broke in the stock market, then we would look to use ETFs. But keep in mind that even in bear markets, there are still stocks that rise. A bear market is not 100% of all stocks going down. There are still stocks that go up. Defensive, consumer goods, oil, gas, essentially commodities. So you can tap into stocks that are in those sectors that can still gain or will still profit from during a bear market. But you can also utilize hedges, if you will, in the ETF market. So while the PE gap does not inform us about the valuation of an ETF, what we can use those ETFs for is to capture we'll likely capture smaller gains of maybe 5 to 8 to 10%, but it allows us to participate in a downward trending market should one occur. 90-minute training be recorded? Yes, it will, sir. So if you can't make it Wednesday or Thursday, it'll be available for you within 30 minutes after each boot camp session ends. Let's see, what else do I have here? Can you go over the email address for the, yeah, hey Tom, let me put it in the chat for you here. Hang on just a second. There you are, sir. I just sent it to you by private message, so you should have that now. Do you sell the 5 stocks at the end of the month? No, we hold those 5 stocks until either their 20% or 10% loss trigger is held, unless we make a material decision to sell a stock beforehand. And those were some of those examples where for example, with Owens Corning, we took a 6.5% gain because we looked at that stock and we figured, we would wind up being stuck in that stock for another 6 months. That was not conducive to growing our portfolio, so we sold it for a 6.5% gain rather than trying to sit out and wait another 3, 6, 9 months for that stock to get to 20%. Same thing on the loss side. If we see something materially change, we tell our subscribers, take a small loss, let's move on, because this stock is not, there's something fundamentally different now than existed before, and we need to take account of that and move on. So those are the only issues. Those are the only times where we will tell people to exit a stock. Generally, exit a stock early. Tom, how many are you screening monthly? Tom, we're largely screening the major indexes, NASDAQ, New York Stock Exchange. We're typically screening about 5,500 stocks. We don't screen, or excuse me, we screen out penny stocks, stocks below $5 per share, stocks with less than 250,000 average daily volume. So again, we want liquid stocks because not only do we want our members to be able to get into the trades, we also want them to be able to get out of the trades. So we're looking for liquid stocks, and typically we're cutting off the lowest, worst end of the market, if you will. Should just be a couple more here, I think. Can you please tell again how to calculate PE ratio in Yahoo Finance? Absolutely, Sonny. Actually, hold on in a second, and I will show you. I just happened to have, I had Yahoo up here somewhere. Give me just a second, and I will bring it back up. There it is. Let me screen share it. And so this will be a little bit of a freebie for everybody because this is a company that I'm looking at right now as a potential recommendation for May. We haven't made a decision on it yet. But as you can see, the company is Delta Airlines. I'm a big fan right now of the airline sector, if you couldn't already tell. And the main reason is because they've figured out how to make money, quite simply. So this is an industry that has made significant changes. I'm just trying to make this a little bigger so everybody can see this. So hold on, and we'll get this in the right places. So again, if you're in Yahoo Finance and you enter your stock symbol here, and then scroll down the left side, you're looking for the Analyst Estimates tab that's highlighted in white there for you right here, and that gets you to this page. So let me make this out a little bit wider so I can read it. All right, so here's how we calculate our PE gap numbers once again. We want the current price, $36.74. We want the current year earnings, which are $2.94. Hopefully everyone gets that. Yep, okay. And we want next year's earnings, $3.39. So to calculate the price to earnings ratio, you would take $36.74 and divide it by $2.94. So again, going back to Tom's question, this is why it's a forward price to earnings ratio, not a trailing 12 months price to earnings ratio, because we're looking at the current year, which is a forward PE. So that's the first calculation, and I don't have a calculator in front of me, so hold on just a second, and we will run those numbers before we wrap up here. So 36.74 divided by $2.94 gives us a PE ratio of 12.5. All right, so here I'll just we'll put this up in this box here so everybody can see it. So we have a 12.5 PE ratio. See, search boxes are good for something. All right, so the next thing we want to do is calculate the earnings growth rate. I'll just call that EGR or EFR. Let's try again, EGR. All right, that's calculated by taking $3.39. So $3.39 divided by your $2.94. And that gives us a 15.3 earnings growth rate. So we can automatically see that our PE gap is about -3. I'm just using round numbers there, but you can see. So you subtract 12.5, subtract 15.3 from 12.5. So you put a little minus sign right there, and there is your PE gap for Delta. It is a -3 PE gap. I would call that a buy, and then apply my 20-10 rules. And there you go, folks. There's a free one for you. But let's get back to questions and see what else we have here. Where are the gray eyebrows? Do you find you generally not playing high beta stocks? Actually, Joel, we typically want higher beta stocks, typically 1.2 and above, because we need to outpace the market with the momentum moves. So we're not playing, substantially high beta stocks, but we do want to have some beta in the stock selections. So it is part of the equation when we run our monthly model. So there you go. All right. Well, I think that's going to wrap it up, folks. That's a great hour and a half. Hopefully everybody got something out of this one. Really appreciate everyone's time here tonight. Again, if you have questions, feel free to send them to us. I guess we lost that. Let me fix that screen. Sorry about that, everybody. And there we go. So if you have questions, feel free. As I said, it's a 60-day trial for $79. You can reach us at our toll-free number there on the screen, 800-863-7650. You can reach us tomorrow. But outside of that, millionaire-blueprint.com/join. And I want to thank everyone for their time tonight. So if you do have questions, feel free to ask them. I think we're doing one final presentation tomorrow. At noon, so feel free to come back at that time. Joel, no, you're not, Joel. Actually, for smaller accounts, I give you a different model in the $1 Million Portfolio Blueprint to follow. Especially for accounts that are less than $50,000. And in part, it's because you have to get more growth in your account. With smaller value portfolios, you can't necessarily just do the 10% then divide by 10 because A, commissions would eat you alive, obviously, and B, you want to have as many $1,000 buckets as possible because that will give you essentially the best opportunity for growing your money, rather than having like an $800 bucket or a $500 bucket. You're better off having as many $1,000 buckets as you possibly can and growing your portfolio from there. So even if you start with 3 and start working your way up to that 4th one, that 5th one. I mean, if you hit, it would take you what, 4 20% trades. Yeah, it would take you 4 20% trades, so maybe 1 to 3 months, and you'd have that $4,000 bucket, and then it would take you 3 trades to get that next $1,000 bucket, and then 2 trades, 1 trade, etc. So, but there is a different division strategy that I give you based on the portfolio size that you're starting with, that allows you to account for a smaller portfolio. So once you join and download that $1 Million Portfolio Blueprint, it'll detail all of that for you in the blueprint. So once again, everybody, thanks for your time tonight. I look forward to working with those of you who have joined us, and for everybody else, again, please pay attention to your portfolios, and I wish all of you the best success. Have a great night, everyone, and we'll talk to you again soon.